Welcome back to Cheddar, everyone. The real estate market is always tricky to navigate, especially right now. Joining us now is Ryan Gorman, President and CEO of Coldwell Banker Real Estate. Ryan, thanks so much for joining us. The real estate
Thanks for
market
having
right
me.
now, undoubtedly, absolutely, undoubtedly impacted and affected by the coronavirus pandemic.
Sure.
Should we expect to see the prices of homes coming down?
No, that's not currently my expectation, nor is it the expectation of most experts who are currently forecasting home pricing. So, if we think back to some of the reasons why people even ask that question, because of the Great Recession, that was a recession that was driven largely by home financing and essentially overbuying. That has not been true over the past decade. That's not what led to this crisis, and I don't anticipate that we'll have anywhere near a similar outcome.
And so, after this pandemic passes, people just aren't going to have the same amount of money in their pockets, though. How long are you expecting this to affect the housing market?
So, housing market being a couple different things. One is the number of transactions we're seeing. And certainly right now, as governors around the country are trying to keep their communities safe, they've locked down. And in many cases, that's meant that the housing market has slowed to a crawl in many different areas. I do anticipate that once we begin to open back up again, which has already started a little bit, will happen much more in May, we'll see that transaction volume begin to increase. The actual home prices themselves, most forecasters, including Lawrence Yun at the National Association of Realtors, is continuing to forecast year over year price increases for the balance of the year. Part of what's happened here is the federal government, of course, has waded in more strongly than ever before to support the economy by putting money into communities and allowing the Fed to buy mortgage backed securities. Really tremendously helps the mortgage market keep rates low.
If mid-pandemic migration is at anything a signal or perhaps a foreshadowing of what is to come and how people will look at their residences in large cities like New York and San Francisco and those that have become hotspots in other areas of the country because they are in such densely populated areas, and we start to
Mhm.
look at some of those consumers perhaps venturing outside of the cities and saying, I'll demand more of my work from home life from my company because then I'll be able to manage my annexation and my proximity to those densely populated areas in the next pandemic, if there should be, unfortunately, another one in the future. How will that impact the housing market and the way that people look at it right now? And what are you seeing as some of the early tea leaves of that migration, perhaps?
Well, some of the markets you mentioned are markets that have had very tight inventory for quite some time, and pricing has been pressured higher as a result of that. But you also mentioned companies allowing their employees to work more remotely. As we think about that, how that impacts buying patterns, if someone's permitted to work more remotely, perhaps that allows them to move a little farther away from the city core where maybe their job is. Maybe that actually increases relative affordability. They can actually afford more home or a home more along the lines of what they're looking for. So I do think what we're going to see is increased interest. You're already seeing that people trapped at home searching online for homes much more than previously. And they may be looking and opening up their horizons a little bit more as opposed to just the city core or within perhaps a half an hour commute to the city. They can work from home half the time. Maybe that opens up their horizons.
Mortgage lenders are being more cautious since the pandemic, doing things like raising the credit score that they're looking for to give out these mortgages. Is this going to make it harder to be a first time home buyer?
So what you've seen with a lot of what are called the large money center banks, right? The biggest lenders, you've seen headlines about them raising the minimum FICO score and maybe requiring more money down. That is absolutely not the case for every single lender around the country. So for many consumers out there looking, I would encourage them, obviously ask your real estate agent, your cold banker agent, hopefully, or your mortgage advisor for the right introductions. But most lenders are continuing to lend without those same overlays of what you're talking about there. I do think the Federal Reserve buying into the market, supporting the mortgage-backed securities market, buying a tremendous amount of mortgage-backed securities that's keeping the market flowing and keeping rates low. So I actually think affordability on a relative basis is increasing a little bit relative to even a year ago based on interest rates.
If things pan out in the fashion that you're suggesting, what part of the housing market benefits more? Is it existing homes that are being put on the market, or is it new homes, ones that have yet to be built, that consumers will start to look at?
So I would love it if the new home builders were able to build at the same level that they would like and that really America needs, especially at the lower end entry level. That just simply has not been the case for more than a decade now. So I do anticipate the vast majority of the benefit here to flow to the existing home market.
All right, Ryan Gorman, who's the president and CEO of Coldwell Banker Real Estate. Thanks so much for joining us today.